Hello, I'm Elaine Zaharis-Nikas, Portfolio Manager on the Preferred Securities team at Cohen & Steers. Today, I'm going to give you an update on preferred security fundamentals and valuations, as well as an update on LIBOR. Fundamentally, one of the most important sectors for preferreds is the banking industry. Banks comprise about 50% of the preferred security universe. We've recently had an update, or we've recently had a good indicator on the state of bank fundamentals with the release of US and European bank stress test results. In the US, the Federal Reserve released stress test results for 23 major US banks at the end of June using year-end 2020 balance sheet data as the base. All participating banks exceeded minimum capital requirements even under scenarios assuming severe stress for commercial real estate and consumer and corporate loans. The loan losses exhibited declined versus prior year results, declining modestly year over year and materially versus December of 2020. These results reinforce the view that U.S. banks have adequate capital with excess capital over minimum capital requirements being quantified at over $100 billion. In Europe, the European Banking Authority released stress test results for 50 EU banks at the end of July, also using year-end 2020 balance sheet data as the base. The main takeaway is that the banks maintain an average Common Equity Tier 1 ratio of 10% under the adverse scenario. Of note, the adverse scenario is quite harsh in that it assumes additional GDP declines on top of what was experienced during COVID. Despite the adverse scenario including more harsh assumptions in this stress test versus the last EBA stress test in 2018, the European banks exhibited only marginally worse capital drawdowns now than they did then, reflecting the improvement in their underlying balance sheets over the last 3 years. Now that the banks have come out of their respective stress tests positively, they have started to announce and execute capital return strategies, including dividends and share buybacks. Therefore, we would expect bank capital levels to decline from their highs post-COVID, but to remain at historically strong levels. So the fundamentals are very good. What about the valuations? An essential consideration for preferred security valuations is the amount of compensation that you receive as a preferred holder relative to senior debt. This is called the subordination premium. It's the amount of compensation an investor receives to move down the capital structure and accept a lower position in the capital stack, as well as to accept payment risks. In general, the greater the subordination premium, the greater the value attributable to preferreds. Right now, investment grade preferreds yield 4.06%. The yield on investment grade corporates is 2.1%. The differential is 205 basis points. This differential is the subordination premium. The average historical subordination premium is 193 basis points. So we are just above the historical average right now. When we look at this, it's important to take into consideration the fact that corporate bond spreads are at historical lows. So when we look at achieving a subordination premium on preferreds that's in line with the historical average, when corporate bond spreads are at their historical lows, then we would view preferred security valuations as attractive when compared to corporate bonds. We come to the same conclusion when we look at preferreds relative to high yield. Right now, investment grade preferreds trade 60 basis points tighter than high yield bonds. The historical average has been over 200 basis points. So what we're seeing is preferreds and high yield trading closer together now than they have historically. Given the higher quality nature of preferred security issuers compared to more cyclically oriented high yield issuers, we would view preferred security valuations as attractive when compared to high yield bonds as well. At this point, I'd like to give you an update on the discontinuation of LIBOR and the transition to successor reference rates. We've had two important developments on this front. First, the cessation date for US dollar LIBOR was extended to June of 2023. This is good in that it gives regulators, issuers, and investors more time to plan for the discontinuation of LIBOR. And for preferred securities, it increases the pool of preferred securities that are callable before the end of LIBOR, therefore reducing the number of preferred securities that would be affected by the transition. On the second development, we've seen the beginnings of legislative solutions to address the transition from LIBOR to successor reference rates. In April of 2021, New York passed legislation that would transition LIBOR-based contracts issued under New York law to SOFR, the successor reference rate to LIBOR. We would expect, or we could see this being a blueprint for future legislative solutions, potentially for LIBOR-based contracts issued under Delaware law and even at the national level. We will continue to monitor the developments around LIBOR to ensure that the LIBOR transition risk associated with our portfolios is minimized. I'll leave it there. We at Cohen & Steers are always glad to share our thoughts and to answer any questions that you may have. Thanks for listening.